Okay, everybody, it's 10:59. It's a 2-minute warning. Okay, Jerry, I've got 11:01.
Okay, thank you, Sean. All right, so let's jump into filing basic. This is the good news. So whether you are new or a returning volunteer who must file a return, this is all spelled out in publication 4012 along with other publications. But typically what happens is when people come to our VITA site, we will assist them if they meet the income limitations and they're within scope. And so you don't have to sit there and try to figure out, do they have a filing requirement? Now, with those people who do not have a filing requirement, you can explain to them, and I'll give you an example. Like at our site, Coastline, I'll make a determination. I'll tell the taxpayer, you don't have a filing requirement. And sometimes they say, well, I want to file anyway. Okay, then we'll file a return for you. You're not the priority, but yeah, we can do that. But typically people who come to the VITA site, they either have a filing requirement or they want to file a return because they're entitled to certain credits. But again, filing is based on your status, i.e. your filing status, your age, and your gross income. And you're going to hear that term gross income a lot in the tax world, and it's actually defined in the publication 4012. And we're going to show you later, you're going to report all of your income unless it's otherwise excluded. And examples of exclusions could include you borrow money. That's not considered part of gross income. Okay, and in other situations, you're going to see this a lot. A lot of people, they've taken money out of their 401k, a tax deferred savings vehicle. And for the most part, they're generally going to be paying what is called a early withdrawal penalty. And you're going to find that's going to be a significant financial and emotional event for a lot of people. They've got to pay the income tax on the withdrawal. A lot of times they have to pay the federal penalty of 10%. Then they have to pay California income tax, and then they have to pay the California early withdrawal penalty of 2.5%. So like I tell my students in my personal finance classes I teach, that's very expensive money, but some people do it. And then of course, they're going to be paying that tax and penalty. And then a lot of people who are brand new to self-employment, they're not quite sure, they don't understand the concept of self-employment tax. And that's legislation that was passed back in the 50s called the Self-Employment Contributions Act, which means you're going to pay income. I stand corrected, you're going to pay self-employment tax, Social Security tax on your income if it's more than $400. And then if you've been in covered California, i.e. you've set yourself up for insurance, you and your family, what that means is you have subsidized health insurance through the taxpayers, and you are required to file a tax return. And then sometimes you're going to get additional subsidies, and sometimes you have to pay things back depending on your circumstance. And then, of course, in our program, a lot of our clients, a lot of our VITA clients, they're going to get certain types of credits. That earned income tax credit's a big one. They want to get a refund. And most people know this. The government will not send you a letter and say, "Dear taxpayer, we think that you are due a refund, and here's your check." It doesn't work that way. You have to file the return. And the general rule is you got to file within 3 years to get that money. And if you don't, then essentially that tax that would have been refunded to you goes back to the general fund, if you will, and you're not going to be entitled to getting a refund. So the takeaway is, the mantra should be, you want to file every year if you have a filing requirement, or if you're going to get that refund. And then for past due returns, there's a lot of people in the VITA program. I've seen this for many, many years. We focus on the current year. I do know that St. Killian's will do those past years, and I think Mel's going to make that determination whether they're going to go back to 2019 or 2020. It's not a bridge too far. You simply have to have essentially 3 packets if you're doing 3 returns, one for 19, one for 20, one for 21, and then simply keep those documents separated so you're not entering data for the wrong year. Amended returns, and Mel, quite frankly, I can't remember what you guys did last year. I don't remember if you did amended returns. I have a policy at my site. We do not do amended returns until we have completed the current year. But when you do an amended return, what that means is you have to have the return that was filed with the IRS or the Franchise Tax Board, and then you have to look at the individual circumstance to determine, okay, did they not report income? Do they need to report more? What's changed? Mel, are you on the line? Are you able to address amended returns?
Yeah, we do amended returns only on existing taxpayers.
Okay.
Our taxpayer.
Oh, they're already in the system?
Yes.
Okay, great. Okay. And again, same thing. If you want a refund, you got to file. The general rule is you want to file within 3 years to get that refund. There are exceptions to that, and you're going to hear that in any tax class that you're in. There's the general rule, and then you have the exceptions to the general rule. Filing statuses, really the issues that you're going to have most likely will be the head of household. And so this is what I tell people, and this is what I do, and I don't make a mistake when I use the Pub 4012. When you go to the 4012, you follow it lockstep, you go through that decision tree to determine what's their filing status. And typically, again, the one that you might have a challenge with is the head of household. But again, if you go to the Pub 4012, you're good to go. Head of household is you have to meet certain requirements. And one of the requirements is you were unmarried, or for tax purposes, you're considered unmarried. And so that means for head of household, that spouse is out the last 6 months of the year, not living with their married spouse. They're still legally married, and they meet other rules, and they can take that head of household filing requirement. And then for the filing joint, I get this question all the time, and people say, well, what's the deal here? So, well, it's an election. That means you choose to do it. I actually had a guy one time a couple of years ago telling me that some federal official required a married filing joint. I said, go back and tell that guy he's wrong. Here's the code section. It's an election, which means you choose to do it. No one can force you to file a joint return, not a judge, not an IRS official, no one. You choose to do it. And then when you choose to do it, that concept of joint and several liability kicks in, which means you are responsible for the tax as an individual or as a couple. And if you ever talk to someone who got divorced and they're on the hook for their former spouse's tax, they're not happy about it. But that joint and several liability, that's the general rule, and there are exceptions to that. And the other filing statuses, again, go to the decision tree, use the decision tree, and you're not going to go wrong. Next slide. Okay, we will talk about the Affordable Care Act in detail as we, I think that's in week 4 of our sessions here. But you should keep in mind the Affordable Care Act. This covers individuals who are in, for our purposes, covered California. You might have someone who moved to California in 2021 from another state. We're not going to do that other state, but again, covered California. That's the Affordable Care Act, if you will, for California. And when you're in covered California, you are subsidized by the taxpayer and you're required to file a tax return. It's as simple as that. And then what's going to happen is your taxpayers are going to come to your site with a IRS form 1095A. And what that is that's the statement that's been issued to the taxpayer because they've got subsidized insurance, they've got it through the marketplace, and it has information pertaining to premiums that were paid by the taxpayer and monies that were paid by the taxpayers on behalf of the taxpayer. And then for the state of California, there's a document called an FTB, which is Franchise Tax Board 3895. And if I recall last year, I think taxpayers came with both of those documents, which should show the same information. Now, this is important. I've seen this. I remember one time I saw this and it was really emotional for this woman under the subsidies. It's called the Excess Advance Premium Tax Credit Repayment. And I'll share the story one more time. The taxpayer had a job making about $20,000 a year, not making a lot of money. And then what happened is she was promoted at her job and she was now making about $80,000 a year. And so when you looked at the W-2, I think it was like right at about $55,000. And then we prepared the return. She had her health insurance marketplace statement. And someone said, "Jerry, what's this excess advance premium tax credit repayment?" I said, "Oh, that's easy. That's the money that the taxpayers got to pay back because the subsidy was too much." So I sat down with her. It was a truckload of money for her that she had to repay. And I explained to her what this was all about. She was very unhappy, but she understood. And she goes, "Okay, I understood." Here's the takeaway. If you know anybody in covered California and their life changes, i.e. they're making more money, they make less money, they've moved, they've had a baby's grown up and moved out of the house, they got married, they got divorced, something's happened. They need to go back into covered California and tell covered California, this is what's changed. And then what will happen, their premium payments most likely will change. And that's critical because if you ever have seen this excess advance premium tax credit repayment, this could be multiple thousands of dollars, which is it's a showstopper for a lot of low and moderate income taxpayers. And then good news, sometimes taxpayers, they receive too little of a subsidy in covered California. And then once we do what is called a reconciliation with this marketplace statement, they're going to get that premium tax credit. And so that's a good thing. And then just a quick note, these lines that are referenced on your slide, these are the same lines, i.e. Schedule 2, Line 2, Schedule 3, Line 9. The same lines for tax year 2020 are the same lines for tax year 2021. And then a couple other things. Again, we talked about the insurance. It's a requirement unless you have an exemption. Exemptions include, for our purposes of the VITA program, your income is below the tax filing threshold. Health coverage is unaffordable. Typically, it's a little over 8% of your household income, or you have what is called short gap coverage, or if you are incarcerated. I actually have a number of taxpayers who were incarcerated that got out, and that would be an exemption. And then you can also have a religious exemption. We're going to talk about the Affordable Care Act, I think in week 4, and we'll go through some examples here with the software. Next slide, please. Okay, probably the takeaway here is when you're talking about dependents, it's all listed on that page C1 in your Pub 4012. And what I would do, I would go lockstep, meaning utilize the 4012 to determine if they're a qualifying child. If they're not, then you would go to the next step, which would be, are they a qualifying relative? And simply follow the rules and ask the questions. And if you do that, you're going to be okay. You're not going to go wrong. Next slide. This is something that I just kind of throw out there, and I think what you want to do is when you're working with a taxpayer, a lot of taxpayers, they're wrapped around the axle because they did not receive an information return. And I tell them, I said, for the purposes of VITA, go and attempt to secure that information return from the issuing entity. It could be an employer, it could be a brokerage house, it could be a bank, it could be a governmental organization, it could be a private individual. Typically, you want to have that information return so you can prepare the tax return. But if you know anything about taxes, Internal Revenue Code Section 61, I teach this to all my classes, and it basically says right here, right out of the publication, it says, except as otherwise provided, gross income means all income from whatever source is derived, which means people come to me and go, Jerry, is this a taxable event? My first response is, well, let's take a look at it. But right now it's taxable under Section 61 unless we can find an exclusion. Examples of exclusions are when you receive a gift. Someone gives you a gift, it's not taxable. You borrow money, whether it's 500 or 500,000, that's not a taxable event. And so there are different things that are taxable and different things that are not taxable. And again, in the VITA program, I've had people time after time, they go, well, you don't know this is taxable. And then, well, you know something? You probably don't know a lot of things either about your line of work. The tax world is huge. There's a lot of material. And so what you want to do, you want to remain focused. You want to stay in a narrow lane. That narrow lane is the VITA program. And your publication 4012 is going to give you your information, your answers. But when you talk about information returns, you want to look at these things because they will explain what happened or generally explain what mostly happened. For example, the 1099 MISC, maybe you receive this and it accounts for most of your income. And so you default to tell me about all your gross receipts. And then this particular document may explain some of that. And that's why you have to answer those, you have to ask those questions. In the VITA program, the W-2, you're going to see that a lot. We're going to go through a bunch of examples in the next 5 weeks. Typically, you're going to have a 1099 INT. I've had this discussion 1,000 times. People say, I didn't get one. I said, well, okay, well, go get one. Well, I was unable to get one. Okay, then let's go back to what I asked you before. How much interest did you receive from all the banks in the world? $900. Okay, great. Then we're going to report $900 in the software because we're looking at Section 61. All of your income is considered gross income unless there's an exclusion. For 2021, you're probably going to see a lot of 1099-Gs, that's government payment, i.e. unemployment compensation. And then you're going to see the 1099 NEC, which is non-employee compensation. And again, I would just offer, when you're talking to a self-employed individual, ask them about their gross receipts. Gross receipts is all of their income that they've received. And again, the 1099 NEC, it may explain the gross receipts in full or in part. And that's why you want to ask those follow-up questions. And there's a lot of different information returns. This is not an exhaustive list. This is a partial list. I've seen information returns every year that I've never seen before. And I'll go Google it and think of, oh, okay, well, that's, I've never seen that one before. That's what's going to happen in the VITA program. But remember, scope of service, you want to make sure you stay within the scope. And that scope is going to be taught to you by your site coordinator. It's listed in the first few pages of the publication 4012. You want to stay in scope. So for example, we do not prepare corporate returns. That's out of scope. We just don't do that. We do not prepare returns for farmers, the Schedule F. We don't do that. That's out of scope. Okay, next slide. Okay, this is something you'll probably see. I've seen this a lot at the VITA site. You have undocumented taxpayers. And so what that means is some of them, not all of them, but some of them will have what are called individual taxpayer identification numbers. And this is the rule. If you're in the United States and you're working and you're living in the United States and you're undocumented, you may be treated as a resident alien by the IRS for tax purposes only. And so we see this a lot at my site. People will come in and say, Jerry, I've lived in the US for 10 years. I don't have any immigration papers. I've been working here. And what do I do? I'm thinking, oh, that's easy. You're going to be treated as a resident alien for tax purposes. So what we'll do, we will go ahead and complete a form 1040 for you. And a lot of times they may have that I-10 and they give that I-10 to their employer. But we'll use the I-10, the individual taxpayer identification number, along with the income that they've received if they're within scope to prepare their return. And a lot of people, they just kind of shake their head, say, well, why do I have to pay taxes to the US? I'm thinking, oh, that's easy. Congress came up with that rule many years ago, and they're going to treat you as a resident alien because, again, you meet certain rules. It's called a substantial presence test, and you can see that calculation right there. And for most people who meet that, again, they're going to be paying income tax to the U.S. This is important. You're probably going to get the question. They'll say, what about my home country? I always tell them, I don't know anything about taxes from Guatemala, or Costa Rica, or Mexico, or Morocco, or France. I just don't. So you need to go back to those people to determine if you have a filing requirement. We don't do that in VITA. The tax professional can help you out. You're going to have to pay for that. But for the US purposes, we'll do the 1040. And then the next one, your IPPIN, which is your Identity Protection PIN. The rules have changed, and thankfully, it's a lot easier to get an IPPIN. So what happens is people's identities are compromised or stolen. And so if someone wants to file electronically, they've got to get this IPPIN, and they've got to essentially apply for it. You can go online on the IRS website, enter data, and you can get this. And then every year you're going to get that IPPIN, which allows you to file electronically. Now, this is important. If you don't want to file electronically, you can still file the return. And then what happens, the IRS is going to get your return. Someone else has already filed the return using your Social Security number. And now that's got to be worked out by an IRS employee, maybe even at an examination. But this is the quickest way to do it, so you can e-file. And then a couple things just to remember. A lot of people, they talk about income they received, and I listen to them, and then I say, okay, your income is covered under Section 61. You usually have an information return, and sometimes people have what is called constructive receipt of income. And I'll give you an example. Let's say you own some shares in a corporation, and then like I own shares in a corporation. And then what happens is I tell the corporation, don't send me my dividend checks. I don't want to be bothered by a $10 check or a $12 check. I want you to take those monies, those dividends, and I want you to reinvest and purchase additional shares. And that's called a dividend reinvestment plan. And so what that means is I've got constructive receipt of income. I chose that particular way as opposed to getting the checks. I'm going to be issued a 1099 DIV information return. And I'm going to report those monies on my tax return. And there are different types of constructive receipt. Typically in VITA, that's the one you're going to see. And then assignment of income doctrine, what that means is for VITA purposes, if you've earned the money, you're going to report it on your return. Some people earn money and then they turn around and they give it away to their brothers or sister. They make a charitable contribution. So you look at it mechanically. Step number one, you earn the money, boom, you got to report it on your return. Typically, you have an information return. Step number two, you make a choice. You make an election to give your money away to somebody or something. That's a separate thing. If you're donating to a charity, you may be able to take a charitable contribution. If you're giving money to your brother or your sister because you want to help them out, that's on you. There's no tax consequence to you, and there's no tax consequence to your brother. Generally, and we're talking about VITA. Okay, any questions before we move on to our tax exercise?
Yeah, we had a question about the identity protection PIN. Is that only for people who have a security breach?
I think the short answer there is if your identity has been stolen or you think it's been stolen, then you want to apply for this. Again, this allows you to file electronically. And I'll use my sister as an example. She called me up one time. She goes, hey, Jerry, my identity was stolen by a bad person, and the bad person filed a return. And now my return's all goofed up. I said, okay, well, you have a couple options. You can go ahead and file this IPPIN, get that, and then you can file electronically, or you can file a hard copy return. It just helps taxpayers to file electronically. If you had your identity stolen, which is my wife had her identity stolen years ago. It's really bad. You got to jump through a bunch of hoops, keep your records, but for tax purposes, if you have a filing requirement, file a tax return. And this is one way to do it, filing electronically. Okay, any other questions?
Yeah, another question is, if you have a client with an ITIN and they come in with a W-2 that shows a Social Security number, how do you proceed?
Yeah, what I remember on that, you're got the ITIN, that's a legitimate number for the taxpayer. You're going to enter the data for the ITIN. And when you open up the screen, the W-2 screen, you're going to still type in the social, if I remember correctly, but the return itself will be filed under the ITIN.
Okay.
Okay. Let's see. Let's go to our scenario, and then we'll have people take a look at that. And then what we'll do, Sean, once we have them read this, we'll jump to the software here. So in fact, I'll just jump into it. So we got a single taxpayer. We'll start off with a real basic return. This individual is about 40, W-2 income, federal tax withheld of 5,000, state tax withheld of 2,000. Their health insurance is paid by the employer. They pay into California SDI, $250. They got a retirement plan at work. And then EIN is employer identification number. And this is important if you're new or fairly new to VITA. There's a mantra that we use when we use the tax preparation software. We're going to key the data as we see it on the information return. That's the general rule. And then we've got a bank information, $15 of interest income. And then we have what is called education. But let's talk about this education, and we'll have someone who's gone through VITA before to give us some input. So this individual attended a real estate school in 2021, paid $500 for the course, and then bought a book and paid $250. Now, what we know is you have education benefits and education credits that are allowed on a tax return. And then you have education that is not allowed on a tax return. So what we're going to learn in later lessons, we're going to learn about the American Opportunity Credit, and we're going to learn about the Lifetime Learning Credit. But this is what you need to know about these credits right now. The school or the university or the college, they have to participate in the Department of Education loan and grant program. So for example, I teach at Coastline. Coastline is a recognized educational institution. So kids who go there, students who go there, they may be able to take advantage of one of the education credits. Cal State Fullerton, that's a qualified educational institution. This real estate school doesn't participate in any type of loan and grant program through the Department of Education. It's what is called a business school or professional school. And so even though the guy paid $750 for his education, he is not entitled to any type of education credit on his tax return. And you're going to see that. You're going to see different schools, and you're going to say, what's this? And they'll say, well, this school is this. You know, it's a typing school. It's this type of school. And all you got to ask them, does it participate in the Department of Education loan and grant program? And is there a IRS form 1098 T as in Tango issued to the student? And if that's the case, then of course you might be able to take one of those credits. So you do want to ask that. So I'll answer my own question. This real estate school that this individual attended is not part of anything where he can take an education credit on his tax return. So we got two entries. We got W-2 and we got a 1099. So if you would, Sean, if you'd bounce to the software, I'm going to walk you through. If you'll take instructions from me, we'll go through this basic return.
Right. You get into the practice area?
Yes, go to the practice lab and go nice and slow so the new folks can kind of see how you jump into the software.
All right. So it's going to be 2020, and obviously sometime later this month, you'll see 2021 as an option, but
right,
we don't have that yet.
No.
All right. So what's the taxpayer's social security number?
Oh, can you display the?
Oh, sorry. Here we go.
Sean, can you share your?
Yeah, sorry. Coming up.
Oh, me, that's a good looking picture of you, man.
Thank you, sir.
All right. Can you see that now?
Yes.
Oh.
Okay, so what we have here, we jumped into the practice lab and we showed you how to get that. That's the Train Pro web that brings you to that landing page. You click that blue button, then it bounces you over here. So we're going to put in a social.
I'm gonna go back here so everyone can see that.
Okay.
So practice lab, then it says start 2020 tax return.
Yeah. And if you already entered the data, then you can search for the client. Okay, so we're going to go here. 400 in your practice lab. Always start with 400, and then you make up a number or whatever number is given to you. 1, 2, 3, 4, something like that. And then we'll hit start return.
And we'll talk about all those other options of profiles later on, right?
Oh, yeah, yeah. Okay, so filing status, again, your publication 4012 is your go-to document. I don't teach the filing status wizard. If you want to use that, fine. But in this case, this individual single. And keep in mind, the filing status for this guy would be his marital status at the end of the tax year. And so if he's single on paper, then he's single. Okay, we're going to put in Billy Franco. That's his name. He's about 40. And then you want to make sure that you get that Social Security card for your taxpayer and your taxpayer dependents, because sometimes people will use a nickname and it's not going to go through when they e-file. So you have to use what's on the Social Security card. Occupation, we'll make them a worker of some kind. And then show all of those various tabs below the occupation, if you would, Sean. So there's a lot of stuff here. The ones you're probably going to use would be maybe the taxpayer is deceased. Maybe they want to make a contribution to the election thing, or maybe they want to use their 2019 earned income to calculate their earned income credit for the current year. So those are the ones you're probably going to use. Okay, next.
The student thing too.
You might use the student thing too. Yeah, that's true. Okay, let's an address. And this is another thing when you're preparing a return, you want to make sure the taxpayer is providing their current address. If they've moved, I always tell people when you move, you want to tell your friends, your enemies, your bill collectors, and your relatives where you're at. And the same thing with the IRS. You want to share that information with the IRS and the Franchise Tax Board. You also want to collect a phone number. And we'll make one up. And then when you hit continue in the software, what happens is the software then saves the data that you've entered, and you should have a little blue tab toward the lower right-hand portion of the screen.
And then for people who haven't used the software before, anything with a little red asterisk on it, you have to fill those in or you won't be able to move to the next step.
That is correct. You're gonna enter data, you're gonna make a mistake, and then you'll get that red icon that says, hey, this, you need to fix this or add additional information.
This doesn't happen very often that you get that much of a delay.
I've seen it both ways. I've seen it where it's very efficient, and sometimes it keeps going and going, and go grab a cup of coffee and come back. It just depends. But typically, you're right. It usually goes pretty quick.
There may be a problem with the practice lab.
Could be.
Here we go.
Okay, so California return, we're going to run through this every time we do the return. So I'll just explain things and Sean will enter the data. Did the name change? Typically, the answer would be no. People's name typically do not change. Renter's credit, for the purposes of the state of California, it's a non-refundable credit, which is a dollar for dollar reduction of the tax. If the person rented property for 6 months or more in California, they might be entitled to this renter's credit. In this case, no, this guy lives with his mom. Use tax typically know what that means is you buy something out of state, you bring it to California, you use it in California like a car or a mobile home, and typically the answer will be 0. But do ask that question. That's one of the questions you want to ask. And then if you paid it to that organization, that acronym CDTFA, that's the California Department of Tax and Fee Administration, They do a bunch of stuff. One thing they do in California, they collect sales tax from businesses. So the answer is no. And then minimum essential health coverage, that's for the Affordable Care Act. We're going to give a bunch of examples, not today though. And so in this case, he's got full coverage through his employer. And here's a note here. There's many different ways to get health coverage. You can get it through your employer. You can buy it from a broker. You can get it from Medi-Cal, Medicaid. You can get it through Covered California. If you're a prisoner in the state of California, you're covered because they've got doctors and dentists at the prison. So there's different ways to get the coverage. Okay, next is your principal or physical residence the same? Yes. And again, if you have a taxpayer who has moved, it behooves the taxpayer to explain to the franchise tax board and the IRS that they've moved. If you get a letter and the letter goes to the last known address and somebody throws it away, and that's your notification for an examination or what is called a statutory notice of deficiency, it's on you. And I've talked to hundreds of taxpayers that go, well, what happened? I'm thinking, well, you probably moved and you didn't share your new address. And that's not what you want to get into. Continue, please. Okay, so we got through this screen, and then we're going to go to the income screen. Well, no dependents, but no. We will have examples of dependents in later sessions. Recovery rebate credit, this particular credit, you're going to see it again in 2021. But for our purposes right now, this individual, let's say he did not get any stimulus payments. And then before you hit continue, let me say something. We're talking federal stimulus payments. You want to differentiate between federal and state. This is only for federal stimulus payments. And I had a couple of clients, we're talking VITA clients, they did not know how much they got. I said, hey, open up your application in your bank account, go back and look for the last year and a half, and they were able to find the amount of their stimulus payments. And then one client said, Jerry, why are the payments different for different individuals? I thought they're all standard for example, single people. I'm thinking, I don't know. All I know is that's what you got, plug it into the computer, and you may get the recovery rebate credit. Continue, please. All right, real basic return here. So what Sean's going to do, he's going to go to the income section, and we're going to open up that common form. You're going to see this a lot in VITA, the W-2. And then there's different types of W-2. Generally, you got a standard one. You might have a corrected W-2. The corrected W-2 would be issued to the employee because the employer issued an incorrect one. So that does happen from time to time. A substitute W-2, that's the one where you've got your pay stub, year-end pay stub that has all that information, and for some reason you did not or cannot get a W-2. So you fill out a substitute W-2, but you've got to have cumulative information from your pay stub. Okay, we're going to go to the EIN. EIN stands for Employer Identification Number. Sean will make it 951234567, something like that.
95, okay.
And we'll key it as we see it. Okay, employer name, whatever pops up. Now, Sean, this employer is not Bank of America. The W-2 says Bank of America with an I. Change the A to an I. There you go. So if you have something where you got the W-2 and you need to make changes to the software, it's as easy as that. Okay, we've got the address. We're going to go down to wages. And in wage and tip, we're going to put 50,000. Federal income tax withheld will be 5,000. And then what will happen, Sean's going to pause for a moment. What we have here, we have auto population of box 3, 4, 5, and 6. Typically, that's what's, you're going to leave that alone unless you have maybe some 401k contribution, which we'll talk about in a later session. But again, the mantra is you're going to key it as you see it. And so if those numbers that auto-populate are not what is shown on the W-2, you simply change it. So Sean, for instructional purposes, go to box 4 and change that 3,100 to exactly 3,000. And then see if you can get out of it. So yeah, so the software will take it. But again, generally, you're going to leave that alone. Okay, for now, we're going to go down to box 12. And in box 12, you're going to see a number of different codes. These codes are explained in the publication 4012. The two codes you're going to spend a lot of time with will be code D as in Delta, and then code Delta Delta, which is two Ds. And so D is deferred compensation, and Delta Delta is going to be insurance paid by the employer on behalf of the employee. And so in this example, Sean, make that code D go away. So that means you click on that little caret, and then you go to the top. There you go. And then the code Delta Delta, which is insurance paid by the employer, put in $8,000. And again, we'll key it as we see it. And then in box 13, if you have someone who's covered by a retirement plan, that'll be indicated. So we'll click there. And that's typically the one you're going to see. Box 14, you're going to see a lot of. Box 14, for our purposes, it'll be that California State Disability Insurance. And then keep in mind, not everybody in California pays into state disability. For example, I teach at Coastline College and a couple other colleges, and I don't pay a penny of SDI. I pay in a Social Security, but not SDI. Okay, in this case, $250. And then we'll go to state information. We'll click on California. And then state EIN, make up a number. And it may take this, it may not. Let's see. Okay, good. And then state wages typically will be the amount that you're going to see in box 1. I use this example. A few years ago, I was living in Cuba, making money in Cuba, and I had to pay income tax on my my wages to the federal government. In the state of California, I did not have to pay any tax. So my wages in box 16 were 0 as opposed to my federal wages. So you may see that from time to time. And then box 17, I always tell people it really should say California state income tax withheld by the employer and remitted to the state of California, but state tax paid. In this case, it's I think we had let's put it $500. And then box 18, 19, and 20, you can ignore that. In the state of California, there are no jurisdictions that have individual income tax other than the state of California. So ignore 18, 19, and 20 for the VITA program. All right, let's hit continue, saves our data. And then we're gonna, and before you do anything, Sean, don't click on it, just hover around that little red garbage can. The red garbage can means you're going to delete the entire entry and start over. Sometimes you're going to do that. And then hover over the blue pencil. If you need to make a revision, you'll click there and make your revision. And then hover over add a W-2 wage statement. Now what that means is you may have a taxpayer with 3, 4, 5, 6, 7 W-2s. If that's the case, you'll enter each W-2 separately. And that way you'll have a list of all of the income statements that the individual has. Hit continue. And then we're going to go to interest income. And then we're going to hit interest or dividend income. And then we're going to go to the top part where it says interest income. And then typically your taxpayer will be issued a 1099 INT. If not, if they have $1 of interest, we're still going to report whatever interest they receive. And this is worldwide interest. If you are a US citizen or a resident alien, you are taxed on your worldwide income. So if you have a bank account in Canada or London or France or Chile, something like that, you're going to report all your interest income. Payer's name, put in Chase or Bank of America. And then your EIN, it'll be reflected on the 1099 INT. That's your employer identification number or TIN, taxpayer identification number. And then we'll throw in an address.
What
And
if
then
you're
interest-
reporting tax income, interest income, but you don't have a statement and you don't know what the EIN is?
Yeah, thank you. That's a good question. I've actually had that. And so what you do is, thank goodness for the internet. So you'll Google the name of the financial institution. Typically the EIN will pop up, and or sometimes you have to make a call, and then you would enter the amount of interest income received. And I always tell people, I guess I'm a little bit of a geek. I go right back to section 61. 61 of the Internal Revenue Code, section 61, doesn't say anything about a 1099 INT. It says all about gross income. So when someone comes to me and says, Jerry, I've got interest income, I ask them how much, and we will find a way to enter that data into the software. Okay, interest income, let's put down 15 bucks.
And Jerry, at the beginning, when you were going over certs, you talked about an international certification, but that's for international income, not interest, right?
That would be for a number of things, to include tax treaties. I believe in the VITA program, if you got income, and that income is from like a Mexican bank account, I think you can enter that into the software. I don't think you need international certification. Okay, early withdrawal penalty. You don't see that very often. I think it's one of the tests in the Lincoln Learn. What that means is you've got you sign a contract when you have a certificate of deposit at a bank, and then when you break that contract, they don't beat you with a rubber hose. What they do is they take a portion of that interest and they call it the early withdrawal penalty. We'll leave that blank for now. Let's go down to the bottom and hit continue. And then you're going to learn as you go through the certifications, if you do have a foreign bank account, you've got to enter that data into the software and tell the IRS that you've got a foreign bank account. It doesn't mean that you're a bad person. It simply means you have a foreign bank account, and that's all. Okay, I think we're done here. Let's go to the left-hand side, and let's cursor down to a little bit further down to health insurance. We'll click there. Well, we want to display a 1040 now. So it says, did you or your spouse or dependent have healthcare or state marketplace? That would be covered California. The answer is no. If you are in covered California, you would hit yes, and then you would continue with additional screens. And then at this time, we're not going to make any changes to the state return. You're going to hear that term conformity time and time again. So generally what happens is on our returns, the state return will conform, or the state conforms with the feds. Okay, this is your 1040. Go through it real quick. So you've got your administrative data at the top. You've got your income of 50,000 on line 1. And I'll make a point here. Wages, salaries, and tips. Sometimes you have people who receive tip income, and they have to report it on their tax return. And then if they haven't reported their tips to their employee, excuse me, to the employer, and the employee then runs the tips through the W-2, if that doesn't happen, then you got to fill out another form. It's called a form 4137 to report Social Security on your tip income. Okay, and then we've got interest of 15 bucks. And then before we do anything, let's go down to line 12. And I always tell people, if you're new, you should look for this word. On line 12, it says standard deduction or itemized deduction. And so what that means is you're going to get either the standard deduction or the itemized deduction, which reduces your AGI, because your goal is to calculate taxable income. In the VITA program, probably the vast majority, probably well over 80, probably 90% of our folks take what is called a standard deduction. And then Sean, if you can go to the left-hand side where it says standard deduction, this would be for most people, those dollar amounts. If you are 65 or older and or blind, then you're going to get an additional amount. But this is for most people, these amounts that are stated there. So for our individual, he's single, line 12 has that 12,400. So the computer has taken the AGI, the adjusted gross income of $50,015, subtracted 12,400, and then we arrive at taxable income on line 15. Do
you want to go to the next page?
Page 2, please. And then I get this question from time to time. On line 16, it says tax. People say, Jerry, how's tax calculated? I said, oh, that's easy. There are tax tables and there are tax worksheets. In VITA, we use the tax table. And so it's built into the software. If you want to check your work, you go to the instructions to the form 1040, and the instructions, once you look up the filing status and the taxable income, you'll determine this $4,318 for a single individual with that taxable income that was calculated. And so that's how that works. And then another line that I like to share with people, I share this with my clients all the time. A lot of people, they're focused on the refund. I don't blame them. But line 24 is their total tax liability. So our VITA clients, a lot of them, they do pay tax, but of course they also get refunds too. So line 24, this is tax year 2020, this is your total tax liability. So this guy has a liability of $4,318. It just so happens he paid it through withholding of $5,000, which means he's going to get some money back. And then if you notice on line 30, we indicated on the software he did not receive his federal economic stimulus 1 or 2. And so that recovery rebate is calculated on line 30. So he's entitled to that. So his total payments were $6,800, tax withheld of $5, rebate recovery credit of $1,800, total payments of $6,800. He owes $4,318. The difference is his refund of $2,482, $2,482. And so this is a real basic return, and this is how quick it takes to complete this. And down here in the refund section, typically in the VITA program, a lot of the clients, they want the monies, the refund to be direct deposited. So they'll provide the routing number, the type of account, the name of the institution, and then the account number. And typically what happens, those deposits will go in within about 5 to 7 business days. Sean, if you would go to the next.
I have a question on this.
Sure.
The stimulus, we got stimulus in 2019, and one of them came, actually, some of us got it in January of 2020, but we reported it as stimulus money back in 2019. Did we not?
Yeah, what happened is the economic stimulus, the first one came out in the, I think it was May or June of 2020. And then the second one came out in January, February of 2021. So the answer to that would be the IRS does not conform to generally accepted accounting principles. The IRS has their own rules, and so that's a violation of GAAP. IRS, Congress doesn't care. They have the authority to do so. So that's what they did.
Well, question is, if they claim that they got stimulus money in 2020 of the summertime one and also the January 21 stimulus, I mean, when I filed returns last year, if they got their money in the summer and they also got it in January of 21, we said, filed it as if they got their full stimulus.
Yeah, and the short answer is when you ask them for tax year 2020, did you receive the economic stimulus payments from the feds? Did you get number 1, how much? Did you get number 2, how much? You'll enter that into the software. And then you're right, I had an accountant ask me, says, Jerry, this taxpayer received the stimulus payment, this federal payment in January of 2021. Why do we put it on the 2020 tax return? And I explained to the accountant, the IRS does not conform to generally accepted accounting principles. That's the answer.
Okay, so why would this guy, we didn't get any stimulus checks in 2021.
Yeah, this is a 2020 example. Sorry, they
Yeah,
don't
this is
have the
2020 and-
2021
Yeah.
function.
And we did have taxpayers receive economic stimulus payments in calendar year 2021. But again, the software, you're simply going to enter stimulus payment number 1 and number 2 if they received it and how much.
But that isn't going to, that won't appear in the 2021 tax layer, will it?
In 2021 tax layer program, you will see the recovery rebate credit because there is a federal stimulus payment number 3 that some people received.
Okay. Okay.
Okay. All right. Can you go to page 3? And let's see what we got here. go to the top. You're going to see this a lot on VITA returns because you're going to have people who have different types of income, i.e. Schedule C net income is going to be reported there. Line 1, you see this from time to time for people who have itemized in the previous year on their federal return. They've taken a full tax advantage of the income that they paid, the tax they paid to the state of California. And what that means is they have a refund that is taxable for federal tax purposes. And you're going to see that from time to time. Other income line 8, you see a lot of this. It could be a prize. It could be an award of some kind. You're going to see a lot of other income. How about next page, Schedule 2. And I don't think you have anything here. Additional taxes, you have different types of tax. The one you see in VITA the most is going to be self-employment tax on net income. You do see on line 5, you're going to see that unreported Social Security tax for the form 4137. We do that in VITA, and that's people receiving tips and not paying Social Security on their tips. And just a quick aside, I've had a lot of people over the years say, Jerry, how does the IRS know if I receive tips and I stick money in my pocket? I'm thinking, well, they may not. But if you get in front of an IRS agent who is trained on use of the Internal Revenue Manual, they will be able to determine what is called unreported income, utilizing what are called indirect income methodology. And you want indirect income methodologies. You want to stay away from that. You just want to tell your VITA client, report what you make. If you don't report what you make, you may, it's possible, it doesn't happen that often, but you may be examined. And then that's when the IRS is going to say, okay, you didn't report your tips, and we're going to show you why. How about cursor down a little bit? These are your refunds, non-refundable. The one that we see a lot would be credit. Now, this is going to change. That credit for child and dependent care expenses is now a refundable credit for tax year 2021. Education credits, we see a lot of this. And all you got to do is you got to remember out-of-pocket expenses, and you got to remember the taxpayer is going to receive a form, IRS form 1098 T as in Tango, which will show the amount of typically tuition that they paid. Let's see. I think that's about it. So I'm going to turn it over to Sean if we have any questions, or if you want to wrap it up and invite people back next week.
Yeah. So does anybody have any further questions? You can type them into the chat, or if you need me to unmute you, let me know.
Yeah, Sean, it's Paul Abrams. I was just wondering when the video is going to be made available for review if I wanted to look, revisit some of these things.
Well, I do have to apologize. We were having a lot of technical issues at the very beginning. So about the first hour and a half of this video is going to be unavailable forever. But the second half of it is working. And as soon as the session is over, I'll save it to the website and I'll send out an email link, which should be within about a half hour after we're done. And I'll send it to all the same people who got the invitation. So it'll be posted on the website for St. Killian Church, but we'll send you a direct link.
Thank you.
Could you confirm that Roger Brown at rogerbrown100@gmail.com is on your distribution? Because I looked in my spam and I looked everywhere. I did not get the link this morning for this session.
Okay, rogerbrown100@gmail.com.
Yeah. Thank you.
All right, so we do have a question here. Jerry, what about paying a state and whether there's a penalty?
Did I understand you paying state income tax to the Franchise Tax Board?
Yeah, I mean, I'm just reading what it says. I'm not exactly sure what the question means.
So if it is state income tax to the state of California, Franchise Tax Board, typically you're going to pay that through withholding if you're an employee. If you are self-employed or if you are an investor, then you're going to make what are called state estimated tax payments. And what I'll do, I'll make a note right here when we talk about the Schedule C next week. We'll show you how to enter data for federal and state estimated tax payments. All right. Sean, any other questions?
I'm not seeing any other. Somebody just made a comment that the 2020 tax return was the way that the IRS made sure everybody got their stimulus payments. So that's why they had all those questions on there.
Yeah, and what it is some individuals, and I actually have paying and non-paying clients that did not receive economic stimulus payment 1 or 2, and they were eligible for those payments. And so what happened is when they filed their 2020 return, they were eligible for that recovery rebate credit. And then I've had other clients who received a portion of their economic stimulus payment 1 and 2. So we entered the amount that they received, and they still did receive the recovery rebate credit. And so it just depends. Just depends.
Yeah, I know that we had a lot of clients who received the first payment, and then the second one was mailed out as a debit card, and there was a problem with those kind of things being stolen. So when they reported that they didn't receive it, but the IRS records show that it was sent out, then that makes the IRS has to investigate what happened, and it could lead to a delay in their refund up to 9 or 10 months.
Oh yeah, I've heard horror stories about refunds, and that's a whole nother session. We could talk about it for hours. Yeah, it's there are some examples. It's really bad in certain cases.
All right. Oh, and apparently it's Omid's birthday. So happy birthday to Omid.
Omid,
Happy birthday.
happy birthday.
All right. Well, thank you very much.
Thank you, thank you, thank you.
It's noon, so I'm going to be ending the session. And as soon as the session's over, I'll be posting the recording as it takes a little while to compile the recording.
All right, thanks everybody. See you next week.
Bye.